morning, everyone. Today we're going to be looking at the fair value gap. And yesterday we looked at mitigation blocks and how to identify one, how to use it to frame your day trading or even your bias for the week, also known as weekly bias. Today we'll be looking at another type of gap, which is the FVG, fair value gap. So from definition, we have that fair value gap is a range. Anywhere you see a range, just know we're talking about price displacement. Okay. So fair value gap is a range in price delivery where one side of the market liquidity is offered and typically confirmed with a liquidity void. Okay. On the other lower time frame charts in the same range of price. So I'll take that again because it might seem like I confused you. Fair value gap is a range in price delivery where one side of the market liquidity is offered and typically confirmed with a liquidity void on the lower time frame charts. In the same range of price, price can actually gap to create a literal vacuum of trading, thus positioning, thus posting an actual price gap. So what we're actually looking at here is we are looking at a particular time in price where, or should I say all this English, is we are looking at a particular time in price where markets was not efficiently price was not efficiently delivered or the market was not efficiently traded by the creation of a gap. These gaps are usually very quick, very fast, and they leave a void whereby inside that void, if you look to the left or to the right, you won't be able to find any trading activity that took place inside that gap. And it's usually just a single candle that has almost no wick sometimes. So how do you find this? Use higher time frames. I recommend daily time frames. And when I say I recommend daily time frame, I mean when you're trying to figure out what is a very good internal liquidity, because fair value gap is a form of internal liquidity, which is an inefficiency. So what is a particular internal liquidity that I can watch out for, I can look out for in order to take a trade off, or not to take, in order to find a trade setup, okay, or in order to find a draw on liquidity. So it can be seen on all time frames, but the one I recommend is let's say I want to take a sell somewhere and I'm trying to figure out where price is likely going to, sell to. I might use a fair value gap, or I'm looking to buy and I can see price is presently sitting inside a daily bullish fair value gap. Then I can drop to the lower time frames and frame my entry from there. But mind you, it is not limited to the daily time frame. It can be seen on even the second time frame. You can see a fair value gap on the seconds time frame, the 1 minute time frame, the hourly, the monthly, even yearly. Every single time frame that exists, you can always find a gap, a fair value gap. So for a case of a bullish fair value gap, three candles must be considered. Okay. You must look at the candle before and the candle after. So we want to look at, for a bullish fair value gap, everything we are going to look at examples. So just follow along and don't get confused. For every fair value gap, you want to look at the high of the candle before the gap and also the low of the candle after the gap. Okay. What do I mean by that? If you look at this chart now, okay, so let me bring my drawing tool. If you look at this chart, we are going to see that at some point we have price consolidating, right? Like all these movements, they were messy and they were to the sideway. Now I'm using a volatility, mind you, I've been mixing it because I'm teaching both. Everything I'm teaching applies to Both volatility for those who trade derivative also applies to forex. Actually applies to anything, to be sincere. So I'll be using a volatility here, and at some point on this 15-minute chart, you can see we had consolidation, and then all of a sudden we have this fast price movement to the upside. Whenever price moves quickly away from a particular point of consolidation, they usually create a gap. And in some cases, they even create a void, such as a vacuum block or a volume imbalance or a liquidity void. They will always create some kind of gap or void. And all these are usually inefficient price, or you know just volatility coming in into the market quickly. Now the beauty is that whenever the market moves quickly away from a particular point and creates a gap, they will always retrace back. There are some cases where they do not do it immediately, where they can take a week before they eventually come back, or maybe even the next month before they come back to fill that previous month's gap that was created. And sometimes they create it in the morning, and before New York session, they are already back into that gap to close it up. So in this case, you can see this is a 15-minute chart. We had it move up, and then it came all the way back in form of retracement. Now, from what I have taught you, this is consolidation, and this is expansion away from that consolidation, right? This is expansion, and then before I say it, what is this one? This is retracement, right? So price retraced back into where? Internal liquidity. From my teaching on internal and external liquidity, I told you that a fair value gap is a form of internal liquidity. Why is it a form of internal? Because it is a particular area where price would like to redeliver or to reaccumulate. And in reaccumulating of new orders, buy orders or sell orders, actually both, it fills up that inefficient price that it already created in the past. So price came back as a retracement to this fair value gap. And if you look to the left, you are going to see these last two down close candles. Like I told you yesterday or day before, I said till the end of the whole 3 months, we'll be using all these terms, especially when we get to part two. We'll be using all these terms to now, we'll be using them, not explaining them. It's just like saying when you go to a catering school or something, they teach you what a spoon is, what a knife is, you know, they teach you how to use the knife correctly, how to cut correctly. But when you are now on the job and you are now a cook, nobody is going to teach you how to use a knife. You will now be using the knife. That it is the same thing here. You are that phase right now where you have taught what a knife is. So when you get to part two, you will start using that knife to cut. So here, teaching you what fair value gap is like teaching you what a knife. In part two, you will be using that fair value gap to make trading decisions yourself. So internal liquidity was filled, and you can see from the gap, we can always figure out what the high of that gap is, what the low of the gap is, and what the mean threshold of the gap is. Now, the candle to the left, like I showed you on the previous chart, that how do you identify a bullish fair value gap? I said we consider three candles, right? The first candle we consider is the one to the left, the one to the right, and the one in the middle. If you look at this area here, look at this candle here. That is the one I considered as the candle that created the first fair value gap. How? Because right here, price was dancing, right? The very first candle that moved aggressively out of this consolidation is this one, this particular one. And if you can look at it well, it has just wick to the downside. It has no wick to the upside. So next, It has a wick to the to the downside alone. Now, the candle before is this one that has this wick, and the candle after is this one here. So that means this one is the candle after the one that created the gap, and this one here is the one before. So the gap between the wicks, that is why I said we want to look at the high of the candle before. This is the candle before, right? So what is the high of the candle before? It is the top of this wick. That is the high. And also we want to look at the low of the candle after the gap. This is the candle after the gap, and this is the low. So you take a horizontal box like that, draw it forward, and pick it between the low and the high of the candle before the gap. So the candle in between them is the one that created that inefficiency. Okay, and then you draw it forward. Then what can you see? You can see price came into it and rejected multiple times. None of all these candles, they were all 15-minute candles. None of them could close even inside the gap. But one thing for sure, they closed up the inefficient price and then eventually rejected. Where will they go next? Of course, to this buy stop liquidity. So this confirms what I was saying. The price moves from internal liquidity to external, and from external back to internal, and it goes on and on and on like that. You can look at any charts of your choice and you'll be able to do the same thing. Now, that is all the explanation I have for fair value gap. As time goes on in part two, we'll be getting deeper drilling into how to use these gaps. And you know, if you look at this chart, here is another gap here, the low of that one, and also I can just decide to pick this one here. Okay. Oh, you might say, oh, why not pick the one after? Well, you can, but a little bit has been retraced back into the void. So I will just pick that one that has been retraced back. Or for the sake of simplicity, you can just pick the candle before and the candle after. And then price can retrace and draw back into this gap, eventually launch and come to form a higher high, taking your profit. So many of you that trade, a lot of you might be take a buy here. And okay, I'm not supposed to say this until the next part, but I've already started. A lot of you will take a buy inside this place, and your take profit is here. But because you now see price get to almost your take profit, then start dropping, you quickly go and close. You don't need to do that. All you have to do is find out if there is a gap that price wants to quickly, retrace into before going back to the buy side, buy stop liquidity right here. By now, you know what a buy stop liquidity is. So price would definitely, if you go and check these charts, you find out that price definitely came back into this void and then eventually went back on. So what am I saying? You do not need to close your trade because you see a black candle. All you have to know is when price come here, you can even add more position. Where would you put your stop? Below the candle after, before the void. This is the candle that created the void, right? The candle before. So if I was going to take a buy inside this place, my stop loss would be below this candle before the gap, which is this. My stop loss would be here because as long as this void is going to hold price up, price shouldn't come that low. Okay? Or to be safe, put it here, which to me is still a very tight stop loss. All right, so next example of a fair value gap. This is a forex chart now. You can see I've explained one on the deriv, and I've also explained the same thing on forex market. So here we can see we have a daily chart on the dollar index. In part two, I'm going to be teaching fully about the dollar index, SMT divergence, how the dollar index is used to make trading decisions across almost all trading instruments, even the ones that are not dollars. So if you look at this chart, we have move to the downside. So between this move up, from this up to this bottom, can you find any fair value gap? Or the price creates any form of imbalance or inefficient price? Well, in my opinion, no, because if you see this candle drop, then this one went all the way back up, to reprice or to retrace, anyone you want to call it, drop down. This one did the same. So if there's any gap here, it should be maybe this one. So it might be something like this. So aside that, there is nothing else. Even on this side, there is nothing to call a gap. But whenever you are able to find one, you can always use it. You can always take it serious or take it up in the market. So the next thing we see here is that for some moments, there is a bullish day here. And if you look at this day, it has no wick to the downside, but a wick to the upside. Now, look at the day before. Usually, the best gaps usually have small candles before and after. That is the one in between, like the candle that created the gap itself, usually have small candles before and after, and it will be the biggest between them. Okay, so if you look at this particular one, see this tiny candle before, this tiny candle a day after, then the one in between created this massive candle. That massive candle is your fair value gap. So how do you identify it? Again, we use our idea of the candle before high, the high of the candle before, and the high of the candle after the gap, which this is the gap. So this low, you take a horizontal line, draw it forward into the future. This one too, the high, you draw it forward into the future. Then you annotate it, you write it there. That okay, this is a buy side. Okay, you can see here I have BISI, right? BISI means buy side imbalance, sell side inefficiency. When we get to part two, we'll start being specific. Because when you use buy side imbalance, you are being specific about exactly what you are expecting. That is, you're expecting, you already have a buy side imbalance, which is this one that was created, and you are also expecting a sell side, that is, price comes back into your inefficiency. Okay, so and then from that sell back into the inefficiency, you get your move to the upside. Now, the way we measured our working block yesterday is the same method we use here. You can always, in fact, anything in smart money concept that has to do with gap, block, whatever, can be measured with a FIB tool. And when you measure it, you can get a 50%, which is known as consequent encroachment. So even this one, we'll be using it from part two. So from here, we can use our FIB tool to get the 50% of this area. And the expectation is always that price shouldn't go far from the 50%. Sometimes they just come to it and then they reject. When they start going below the 50%, they are entering into discount of that gap. And that can even give more better opportunities or cheaper prices to buy from. So you can see price came into this gap. A lot of people would see this daily candle here that drop massively and be like, the following day too will drop. Nah, there's a gap here. And this gap can act as a threshold. You know what a threshold means? Something that can hold something or hinder something from moving forward. So we have it drop into this, you know, fair value gap, which is a buy side imbalance, sell side inefficiency. And then what was the reaction? The following day price moved, then the next price moved. So while price was moving, you can see it created another gap. Look at this green candle, very massive. Now look at the candle before and after, small and small. What does that mean? It means it is likely that price comes back into that and then buys again. So the head, like the high of the candle before is at this point here, and the low of the candle after is at this point here. So I had this rectangular box drawn like that, and then I labeled it as BISI, which is buy side balance and efficiency, which is a form of fair value gap. So from there, you can see my arrow. I expected to find a bullish market structure here on lower time frame. So you are not going to be trading these on what this is, just to build a context or a framework to work by. So after building the idea that okay, on daily time frame, price is inside a fair value gap, a bullish fair value gap that might cause a buy, then you can now drop to 1 hour, drop to 4 hour, drop to 15 minutes, even 1 minute to find a buy opportunity using market structure, which will be taught in the next in the part two. Okay, so just make sure you make it to the second part of this course. So there we have it, rally to the upside. So while this moved to the upside, what did they do? If you look at this high, that high, and this high, what are they? They are retail double top, right? And we said anytime we have retail market structure, they are always or usually areas of liquidity. In this case, double top is a buy side liquidity pool. Why is it a pool and not a buy stop? Because it is two now. If it's just a singular point, it can just be a buy stop liquidity. But as long as it is, there's one, there's two, there's even another one here, there's another high here, making three. That's triple top. So a lot of these traders only see a seller. But you as a smart money trader, you already know that price is only dropping into this fair value gap and will go up. Same thing here, drop into this fair value gap and eventually would go up. Now, what if price comes into this area, try to respect it for some time, then for some reason comes into this gap here. No, we have another gap here, you know, comes into it and then drops. Well, the market structure would have shifted, because if you now drop to lower time frame or the 1 hour or 4 hour time frame, you will now find out that price has now created a shift, SMS, a shift in market structure. You will also learn that in the second part. So that is real market structure analysis now. So price can come in to this one, use it as a bearish fair value gap, and drop. Now, my focus won't shift yet until we close outside or below this gap. As long as we invalidate this gap, then price is definitely not going to go up anymore, because that would not only invalidate this gap but also cause break of market structure, which is this slow. So this is a live example. This was a trade. I think this is one of my iconic market structure analysis and trade. I remember, I think 2 years ago or whatever, I made this analysis. I'm teaching them because I like to pick the best of the best. So this particular setup, I took it. It was a precise entry, and if you look at it very well, you can see we have a gap here, a fair value gap, right? So this gap, this red line here, is all the way from daily. I wish I can show you the chart, but I remember it very well, so I can explain. So I was looking at price on daily, retracing back into a garish fair value gap it had created on the daily. And then I wanted to buy that opportunity or use that opportunity to take a buy. So I took a buy from here, and I believe I also took a sell from inside the fair value gap. And what I did that made this trade very legendary is that I had two setups, and two of them met precisely. I had a buy setup, and I somewhere also had a sell setup inside this place, and I sent it to my signal group then. And two of them price just came from here left, also came to me, the second one also left. So I think I'll find that particular one and share it. So what do we have here? I was looking at a daily, so price was dancing down here, and then I was looking at a daily bearish fair value gap, and then I wanted to buy into it. But in order to buy into it, I needed to see market structure on the 1 hour time frame. And what was the market structure I saw? I saw something very simple. That is, price was dropping, making. And mind you, there is no any form of a trend line here. For those who like to find trend lines are rubbish. They are imaginary, and you can only see them after they formed. And the ones you see while it is forming usually fail. So it's not the best thing to put your trading career on. So here we can see lower high, lower high, lower high here too. And at some point we had a massive outburst of that high. That is bullish break of market structure of this high, right? From our lesson of market structure. So next, what I wanted to see was, okay, we have a break of structure. Which candle broke that structure? Those kind of candles usually are the ones that create the gap. So here we have a gap there. Can you see? So this big candle that created this break of market structure, break of this high, created a gap. And how would you identify? Look at the candle after and the candle before. They are small, right? Then you identify the high and the low. Then the difference between them is your fair value gap. So what do I expect? I expected price to drop and touch that fair value gap. So touching it like this is known as IOFED, which is institutional order flow entry drill. In the second part, I also will be using that to take trades as well. So there's a lot of things that you still have to know. Now, a lot of you might be confused and be like, there are just too many things. Trust me, at the end of the day, you will have to pick just one or two things that works for you. Whatever you pick, you will always make money from it. I know someone that is a multi-millionaire and all he trades is nothing but fair value gap, nothing else. Doesn't trade other block, doesn't trade institution, doesn't trade value, just fair value. And I know another guy that is a other block guru, only other block, nothing else. So whatever at the end of the day you pick, I can guarantee would always work well for you. But it is best that you understand everything so that you are not ignorant of anything. So price comes there and look at how precise it was. Then started leaving and then eventually blasted up. This was over maybe 100 pips or so. So use one lot on this trade, you make about 1.5 million naira using the currency exchange of today. So even while they were doing that, you can see I even identified another uh, fair value gap and I was anticipating price coming back into it. Now, what if they drop and go past it? Fine. There's another one down here. Down here. That might be the one they want to close. Sometimes they go lower and close as much as possible. And sometimes they just close the first one. Come here and then finally come or whatever. So this is another one. So from this chart, we can see we have a this particular candle here. Look at the candle before and the candle after created a gap. And if you draw it forward that way, you'll be able to see that price dropped into it and eventually made its way to this bullish order block, this last down close candle, bullish order block. And if you notice, I took my buy inside the fair value gap and I had my stop loss below the order block. Took this buy and it just went in profit. Okay, so that is all for today. And your assignment is you are going to find any chart of your choice and then you are going to find a bearish fair value gap. Here we have everything I have here are bullish fair value gaps. So the way I have a bullish fair value gap, that is price comes into this bullish fair value gap, you are going to do your analysis and find a bearish fair value gap that price will trace into and sold off from. Here I've been showing you buying, 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 right? All my examples are buying, 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 buying. This one too is buy. These are also buys. This is also a buy. So you are going to find two. Okay, let me see. Just one chart. Find a bearish fair value gap, a gap actually, and then find there must be a proper notation here. This high you write BMS plus BMS, which is plus means bullish, negative means bearish. So if it is a break of structure to the upside here plus BMS, then this is a retracement into this fair value gap. So for you, it will be minus BMS, that is price breaks a previous low, breaks it, and then goes back into some kind of fair value gap to sell off. So I hope you learned something, and I hope you'll be able to do the assignment. And please submit today. If you're not able to submit today, there's no need to submit again, because if you do, I probably will not look at it. All right. Have a nice day.